Good afternoon, guys, and thanks for joining my webinar on where I think the All Share is going for 2015. As marketed, this is probably the single most important chart of the year. This is a technical view, as I am a technical trader, but these opinions and views are all my own, and I have been known to be wrong before, but I think this chart tells us quite a lot about what to expect. So we're going to take a look at the charts and have a look at where I think this is going. So just my methodology quickly. This is technical by nature. We're going to analyze the All Share chart, and then I'm going to look at the major sectors, and then try and derive some stock picks that might benefit us should the following occur, and then I'll open up to a couple of questions. Okay, so the one chart that we need, it's the All Share Index. So guys, as we can see on the All Share Index, we have had a period of consolidation before a major breakdown around the September-October area. It was not a very pretty time for the market, but as you can see, it has bounced back quite significantly. And this is quite important to note that this market has bounced quite hard. Now this data is the weekly chart, and this is up until last Friday. As we can see, last Friday created a little bit of a doji, and the market is a little bit overbought at current levels. Okay, so this is the breakout I was talking about. Quite significant about this breakout is that it hasn't even retested that level. Still overbought and still looks quite strong even though it's in an overbought zone. But very significant at the moment is the old trend before that sell-off in September and October. What I'm waiting for to see is whether the old trend is resumed by the current kind of new one that's being born. The problem, though, that I see with the new one is that it's shot up so quickly in a very short space of time. Now I need to look at and show you the power of 50,000. This is a massive level on the All Share Index. So we've got this line at 50,000, and I just want to show to you how important this line actually was in the big picture, in the grand scheme of things. There was our first break of the 50,000 level. So right around here, we tested. This took about 4 weeks, and eventually when it broke out, the market did shoot up quite significantly, and then managed to stay above this 50,000 level until there. When 50,000 was breached the first time since the breakout, it failed horribly, and this is where we had that massive sell-off. Again, we can see a slight break of the 50,000 level. Everybody got excited around these levels, and that lasted for about 2 weeks, where we had a massive failing low, which must have stopped quite a lot of guys out of this market, and then the break failed when it breached 50,000 again. So as you can see, 50,000 is massive. The last break we've just experienced around January, the end of January going into February, this market has built up such a head of steam and hasn't slowed down for 1 second. So this is just to show you how important this 50,000 level is for the All Share Index. This makes it, in my view, major support. Okay, significantly on this chart, after the first breach of 50,000, I've just blocked this area of consolidation. Now, an area of consolidation is very important because it gives you an idea on the next break, when it breaks out of consolidation, of the direction of the next move. And as we can see, when it broke through the bottom of that consolidation, the move was violent. But what it has given us is a couple of levels to look at and to consider to see where this market is going. So if we take the top area of this consolidation period, which we've now clearly gone through after the recent rally, we have what I'm terming a mini support or a very weak support level. That is the top area of the consolidation. The bottom, I've just zoomed in a little bit here. The bottom of that consolidation I'm terming as a semi-strong support because it's much stronger than the top of that consolidation, which failed the first time. But as we know, and the recent market move has shown us, that that level has been smashed. So right now we are waiting to see which support level is going to hold. But I have a theory. We zoom in a little bit more. I've just put in some levels here on where these support levels lie. So the doji that was formed last Friday on the whole of last week's data was at 53,344 on the all-share index. Now our weakest and mini support level is around 52,000, which is not a long way away relatively speaking. And the support gets stronger the lower we go. So obviously the nearer to 50,000, which I've already said in my mind is major support on the index at the moment. So at 50,700 is the bottom of that area of consolidation, which occurred from around August, July, in that area. So what this market is doing to us right now is taking us further and further away from support levels, which means it hasn't even established a new support level on the current move. Now just to put this into perspective, if we take last Friday's data, last Friday's close, to my semi-strong support and my major support, these moves become quite significant. We're getting too high, too fast. So as you can see around here, from 53,300 down to my semi-strong support, we're about 5.2% away from that support level, which is about 2,600 points. But the major support is also getting further away, and there we're heading closer to 7%. So this is quite dangerous territory in my mind. Now, I just want to have a look at the stochastic oscillator for a second. Now, where the yellow arrows are is where the recent surge started and how long did it last. So that area to that area over there took us 1, 2, 3, 4, 5, 6 weeks to do the first stochastic move. And just bear in mind that the market didn't even manage to get into any sort of oversold region. Okay, the market is now heavily overbought because people have been buying this market up so aggressively, and obviously due to various factors. We have stimulus out of Europe, further stimulus out of China, America putting interest rate hikes on hold. So a lot of excitement in the market has pushed our market up and followed the rest of the world up. But if you take a bigger stochastic move, if you just look at the white arrows now, from where this rally actually started, from the last low, the last time this all-share index was oversold at all has taken 18 weeks, okay, which is a relatively very short space of time for the market to rally so hard. And this is very significant because when you're trying to determine where the market is going, a very swift move can often lead to a very swift move in the opposite direction. And this is what I'm trying to be very, very cautious about. Okay, now let's just strip out the index a little bit. If we take the all-share index and we strip out financials and resources, really leaves you with industrial counters. Now, the little white block over there is what's termed a rising window or a gap. And this happened around that January-February period where the all-share index started its big move. Now the thing about rising windows and gaps is they invariably close. Okay, the problem that we have now is that it's also around 5.5% above any kind of meaningful support level. This is quite significant And this is just the industrial counters. Now we look at the resource sector. On this chart, we can see that the resource sector is trading at, or has been trading, very near a resistance level, which is very significant because our index is quite resource heavy. We can see here that by last Friday, the index was trading at around 45,700, but since the move started in January, it's up a massive 13.7%. And that is just the resource sector on its own. That is significant and also very dangerous. So let's just look at the sector performance here for a second. From January, resources have climbed 16.3%, industrials 9.5%, and financials almost 11%. This, again, I cannot stress enough, is a very, very big, swift, short, sharp move. Here's the problem. Everybody get ready to bungee. Resources are now currently 10% away from any meaningful support. Industrials about 6% and financials almost 8% away from any meaningful support level. This is dangerous. It is kind of like jumping off a bridge and hoping that your bungee cord is going to hold you at the bottom. Let me remind you, this is how far the all-share index is from support at the moment. 5.2%. And that is a mini correction. And that is what I've been waiting for. And I've probably gotten short of this market a little bit too early because I thought that it had overrun already in January. But now that we're just over 5% away, I think 5% is a good number to start looking for some support in this market. We've bounced too hard, too fast. So when do I think this correction will start happening? Well, my theory is very simple. We've got futures closeout on the 19th of March. Now, while I don't think the rally is going to be that extensive at the moment, I do think stocks or the index will hold its levels up until the 19th of March. I mean, it is the end of the quarter. Guys are going to have to start, or they're going to want to report a little bit of performance. The market has rallied significantly, especially after those horrible, horrible lows in October. And if you manage to survive that period, you would have been handsomely rewarded for staying in the market up until now. But I don't think it'll be very wise to stay in the market after the end of this quarter. Again, this rally took 18 weeks to achieve these all-time highs. Okay, so let's look at a little bit of my logic. So I do see a bit of a no-brainer just ahead. Resources have the furthest potential downside because they've rallied the hardest. Okay, this is not brain science or rocket science. I just get very scared when things rocket up like that because the move in the opposite direction is normally just as violent. I believe that resources will lead the next correction. And I think we can even start seeing from today and even yesterday that resources are starting to wane a little bit, especially with the likes of Anglo American coming off those recent highs, Sasol getting pummeled, and most of the miners like African Rainbow Mineral have been hit very, very hard. So I think we're already starting to see signs that money is switching out of resources. So far, my prediction seems to be going my way. Industrials and financials, while strong, have lagged resources, which is very significant, and we'll see why. Very importantly, resources are trading at, or the index itself is trading at medium-term resistance, and financials and industrials are not. In fact, there is no resistance at the moment because they've gapped up to make new highs. Resources have not. Industrials and financial stocks should reach their support levels sooner when the market corrects. By sooner, I mean sooner than the rest of the all shares, sooner than resources. Okay, don't kid yourselves, guys. 50,000 is a massive support level and will be the best buying opportunity. You're welcome to try and have a nibble at this market at those previous to the weak and the medium support levels. But in my mind, 50,000 is a colossal level for this market to go up. Markets don't go up in a straight line. We are in major overbought territory across sectors. Okay, and we desperately need that kiss goodbye for this market to continue higher. By the kiss goodbye, you can see on the dotted lines there that I've put in the semi-strong support at 50,700 on the index. Now that is a medium strength support line or a semi-strong. Okay, so if I do see the all share index bounce off that line, it is a tentative buy for me to start going long stocks again. But as I said in the first two slides, I think there's a birth of a new trend because I don't see the market having rejoined or the previous old upward trend. So this is where I see potentially the all share index going in the very near future. And if we just look at the formation since the break, it's taken 1, 2, 3, 4, 5 weeks to make a bit of a top. So I expect within the next 4 weeks, which takes us to around about futures closeout, where I expect this market to correct slightly back down to that semi-strong support level. What I would love to see is it to join the new trend that has been born. If it joins the new trend, it adds so much strength to the underlying market and gives me higher conviction to buy. And guess what? It's very near our 50,000 level. Okay. So I'm calling this market to correct. And what happens when a market corrects? We get volatility. So here's some more logic. I call it how to ride out the storm. So when selling increases, volatility increases. That is a fact. And unfortunately for traders, when volatility increases, emotions become very hard to control. And this is where I find a lot of my clients get married to trades and refuse to accept defeat or even close out those bad trades. Okay, volatility can make or break you. And again, don't kid yourselves. A 5% correction on the entire index is a massive, massive move. I'm not saying it's going to happen overnight, but I am saying that be prepared for this correction to come because sanity does have to prevail in this market. So when trading through a selling period, the less volatility, the better. That makes sense. So let's look at volatility. First of all, I've added a Bollinger Band onto the resource sector in 2 standard deviations. Now, very significant about the Resi is that the price action is pulling the Bollinger Bands down. It is the only sector where this is occurring. Okay, a very dangerous and very volatile sector to be a part of. And as I mentioned before, without taking volatility into account, I do believe that the resource sector will lead the way down. And naturally, when your heaviest sector starts pulling the market down, the rest do tend to follow. But if you're going to trade during this period, volatility is the last thing you need. So I would stay well clear of any kind of resource counters, especially not trade that index. Let's look at financials. It's a little bit smoother, as you can see. Luckily, the Bollinger Bands are nice and steady, going up in an upward direction. But you can see financials are trading right up at the top of the Bollinger Band. Also, 2 things can happen here. It can revert back to the center line, back to the mean, or it can break out. But as things stand, as we get closer to futures closeout, I expect financials to hover around these levels, and they have been super strong even with the declining rand. But what we do see here is that the Bollinger Band at the top here, or at the recent price action, is starting to get very, very wide between these deviations. And this is also a very dangerous place to be. Industrials. Now this looks like a lot smoother ride to me. They've consistently traded above their mean, their center price. Yes, they are trading at the top of the Bollinger Band. But when there's volatility ahead, I'd rather be in a sector or in a trade that offers me the least volatility so that we can keep our emotions in check and stick to our trading plan. So as you can tell, industrial still offers me the smoothest ride. So here's some more logic. Pick the sector that'll offer you the smoothest ride. Pick stocks inside of that sector. So industrials is my preferred sector. It offers you the smoothest ride in terms of volatility. It is the closest index to support. It only has about a 6% move to go as opposed to the financials and the resource stocks. But resources obviously are too volatile for us, or for me. It carries the most rand sensitive stocks, which makes it very defensive. So here are a couple of stormproof trades in my mind. One of the stocks that I've identified is Remgro within the industrial sector. I'm not going to delve too much into the technicals of it now because this all-share chart, as well as the industrial sector chart, has already told me to expect a pullback. So I won't be buying Remgro right now, but I definitely will be climbing in when we get this pullback. The reason I'm buying Remgro is because it's a diversified industrial. You're going to get automatic exposure to Mediclinic, which is also defensive because it is dual listed, as well as FirstRand. So you do get a little bit of a pinch of a financial in there as well. Nice diversified industrial to have to help you ride out this sell-off storm. And then one of my favorites, even in a storm, is Steinhoff. It's more of a rand hedge play. 63% of its revenue comes from Europe, and they will be listing in Frankfurt soon. In fact, yesterday there was a note that their Frankfurt listing would be approved when the Pepkor deal is approved. And yesterday it was announced that the Pepkor transaction has been approved without any exclusions. So it looks like Steinhoff is getting ready and setting up for a nice big bounce. But of course, we do need to wait for support. SAB Miller. Now, I had to think a little bit out of the box for this trade. As a stormproof trade, again, as you can see, it's a rand hedge play. A lot of the revenue is earned in pounds. It's a pound-sensitive trade, especially on our market. The weaker the rand gets to the pound, the better for the share price. Okay. Now, the Rugby World Cup in the UK should see pound strength and support the price. Now, why would I even think about the Rugby World Cup? Well, in my mind, September is not that far away. And logic tells me that there'll be quite a few tourists traveling to the UK to watch the rugby or even just visit family and friends for the occasion. Now, what happens when people go overseas, they need to change their currencies into the local one, which will be pounds. So I think as we start getting closer and closer to September, the more demand for pounds, the stronger the pound is going to get. And the stronger the pound gets, the more it's going to support SAB Miller. So this is a stock I would definitely be looked to holding after a correction or a slight pullback, and hold the stock possibly right up into December. Okay. Also, there are rumors flying around that there's a potential takeover bid from a consortium of guys that think SAB is worth buying. I particularly don't like trading rumors like that, but if it does happen, you might get a little bit of extra cream. So those are my 3 stormproof trades, but let's just go back to the conclusion that I've made. The market is overheated in the short term. Broad-based breakouts have occurred across sectors, so new support must be retested. We haven't had that yet, guys. So just as I showed you the financials, the industrials, those have all broken out and haven't retested that breakout level, which is supposed to act as support. I mean, even our the whole all-share index hasn't tested support, and it's looking very, very top-heavy. Also to consider, commodity prices are coming under a huge amount of pressure, especially with the slowdown in China. So when commodity prices come under pressure, resource stocks come under pressure. So that's why I say further impetus will be added to resources leading this index down. So my prediction is that at least 5% correction is on its way. And as I said, I expect it to start. It's imminent. And no later than the 20th of March, let's get this futures closeout out the way. The resource sector is trading at medium-term resistance. Financials and industrials are not. Industrials and financial stocks will reach their support level sooner when this market corrects. Notice I said when, not if. And then again, please don't kid yourself. 50,000 is a massive support level and will be the best buying opportunity. I know people are long naturally minded, but I'm waiting for 50,000 before I start climbing in heavily. Now in a trader's market, we like a little bit of volatility. I trade every single day and look for opportunities. But if you're going to go long equity and you're looking for a time to enter this market, and it doesn't matter which sector or which stock, you need to see if 50,000 holds on this index, because this is a colossal level, as I said before. But I'm not a bear. I really believe that this bull market should run till at least the end of the year, but not before it finds support. We haven't had support. So guys, I do think that if you're long and you want to ride out the storm and you're happy to face a 5 to 6% correction on this market in the short to medium term, I really believe that this market has still got a lot of legs. It's the most unloved bull market we've had ever. So yes, I am bullish about this market. I don't think it's going to collapse. However, if 50,000 does not hold, it's going to be the biggest short signal you've ever seen. And that's my opinion, and I'm sticking to it. Like I said earlier, I've been known to be wrong before, but this is where I believe the market is going. I'm waiting for this pullback between 5 and 6%, and then I'm going to trade my stormproof stock picks. Guys, I'm happy to take some questions. I'll just give it a couple of minutes. Let's see if we get any questions. I hope the sound is okay. I see a couple of some nice questions coming in. I know there was a problem with the sound earlier. I hope it's fine now. I saw a question here. From James, if we're already holding stocks like Kumba, do we lose them even though we are not taking profit. I don't quite understand the question, but I know you're going to be getting a dividend on Monday. Kumba has been sold off quite heavily. I do think there's potentially a little bit of downside should the market correct, especially with China slowing down. I mean, if they lowered their GDP forecast just yesterday. Unfortunately, the iron ore producers are still pumping out iron ore at maximum capacity, which will drive the export price of iron ore down. So I expect Kumba to languish around these levels for quite some time. But yes, if the market does correct, as I think it will, Kumba will follow the rest of the resource stocks. Then I've got a question from Greg. What direction will you trade the correction if what direction will you trade if the correction does not occur by the 19th? Well, Greg, the first rule of trading always is the trend is your friend. So if the trend remains very strong after the 19th, I will definitely stay long. But if it doesn't and we do start seeing momentum sway to the sell side, I most definitely will be taking money off the table and not going short because I still think the market's going up, but definitely be taking money off the table and to see if my little support levels hold. Okay, another question here from James. Sasol is not connected to oil as strongly as market trends it. Will that fall still further? Yes, James. From a technical point of view, it is a chart that I look at every day. It's become for me very much a short the bounces stock. It really has weak rises and stronger falls. I have shorted it about 5 times in the last 10 days and made money every single time. The problem that Sasol has is that it is quite connected to the oil price, because remember, they sell their oil in dollars. So the cheaper the oil price becomes, the less they make, and it's a significant difference to their revenue. Also, the fact that Sasol has recalculated or restructured the way they calculate their future dividend has also thrown a little bit of turmoil into the share price. Guys don't know how to price it fairly yet, and when there's uncertainty, there's normally selling. So unfortunately for me, it is a short the bounces kind of stock. Guys, I'm still open to a couple more questions. I'll let it run for a few more minutes. If there's anybody who has a question. And also, we will be posting this presentation. We'll also be mailing it to all the registrants, so my details will be on there. If there's any questions you have, maybe on a bit of a sidebar, you're welcome to contact me with regard to this chart. But I hope I added some value. As I said, this is my view, it's my opinion, and I'm trading it. So thank you guys very, very much for tuning in, and we'll see you next time.